Kurt from Clifton Accountants. Today we're going to move on and talk about part 2 about knowing your numbers. And this time we're going to talk about the balance sheet.
The balance sheet really is about finding out and looking at what you own compared to what you owe in simple terms. So you've got your assets, what you own in your business, and the liabilities being what you owe.
Yep, and if we just break that down a little bit more when you're actually looking at your balance sheet, there's 2 terms that are used in both assets and liabilities, and that's current and non-current. Current are the things that you're either going to get a benefit from or you owe sometime within the next 12 months, and non-current is stuff that happens or is going to happen outside of the 12 months. So that just gives you a little bit of a breakdown to the terminology that's used.
Now we get to see a lot of business financial statements, profit and loss and balance sheet. One thing that we see a bit, which can be fairly ugly, is businesses that make really good profit. So if you look at their profit and loss, and it's a very, very healthy business. But if you then turn over the page and have a look at the balance sheet of that business, it can actually be a very sick business. So it looks great from the profit and loss, but very sick from the balance sheet, because what that business owes can be more than what that business owns. So if you're in that position, even though you've got a healthy profit, it's actually a real warning sign and something you need to be aware of and take action about.
Yeah, and it could be for a variety of different reasons. It could be that there's massive overdraft, for instance. So the business is running in overdraft all the time, paying exorbitant interest rates on an overdraft, or there's business owners have seen, we're going well, so they've gone and brought vehicles and all sorts of non-income earning assets and really loaded the business up with a lot of liabilities that they're just not getting a return out of, because that really is key.
Now, talking about buying vehicles and income earning assets, we get the example all the time where people come in and say, can I claim this car against my business? Now, usually the answer is yes. But there's a difference between buying a car because you want that car and buying a car because you actually get a return on even a car you can get a return on. For instance, a builder buys a ute. They need a ute to carry on their business. They carry tools in the ute, they carry materials, whatever. So that ute actually provides a return to that business owner. On the flip side of that, if you go and buy yourself a $200,000 passenger vehicle, then that's a depreciating asset. There's no return. It doesn't really add to your business in any way. It doesn't provide any value. Now, we're not saying that can never be done. You just need to be in the right asset position and the right liability position to be in a position to make such a purchase.
Yeah, that's right. And making sure, like Kurt said, that you're getting a decent return out of these assets. And another couple of terms that are used when it's talking about balance sheets are liquid and non-liquid or illiquid assets. And what they're talking about here is how quickly you can turn them from what they are, like a piece of machinery or shares, into cash. Property in a balance sheet is one of those examples of something which isn't terribly liquid because it can take an extended period of time to actually sell that. Vehicles and certain pieces of equipment, you can tend to turn those back into cash fairly quickly. So managing that balance between liquid and non-liquid assets is also pretty important.
And when you think of liquid and non-liquid, you need to look at what your liquid assets are. So your accounts receivable, your cash, your things that you can quickly turn into cash, compared to what your liquid liabilities are. So if you've got liabilities that are going to be due to be met in the next 12 months, and you don't have enough assets to cover those liabilities, then you're in a dangerous situation, and you need to be doing something to right that balance. Often where people get into this drama is that they pull more money out of the business than really even the profit is. So businesses are going great, they pull money out of the business, and sometimes we look at balance sheets and they've got a significant, for instance, superannuation payable. Now that's a current liability. It needs to be met every quarter, and yet it's not being met because the business owner is funding their own lifestyle with the profits rather than meeting their obligations.
Yep, absolutely. Look, and we see that really key in this, and now whether it's looking at the profit and loss or the balance sheet as we are at the moment, the reporting system that you've got and the accounting system that you're using, it's vital that's got timely information that's accurate and up to date, because otherwise you can be relying on old information and you don't actually realise the position that you're in.
An example of a system that we use is Xero. It's cloud-based. It's very easy to use. So if you don't have a bookkeeper, for instance, business owners can use it themselves. And it provides timely information. So it's really important to get a system that you understand, a system that's easily linked in with your accountant, and one that gives you up-to-date information.
Yep. So get to know your numbers a lot better. Come and see us at Clifton Accountants and contact us at cliftonaccountants.com.au.